What the finance is happening right now? Do you know that South Korea's stock market lost roughly a quarter of its value in just a few weeks? Even after that fall, it remained about 60% higher for the year. How could one market look incredibly strong and dangerously fragile at the same time? The answer begins with artificial intelligence. But AI alone does not explain what happened. Record chip profits started the rally. Two giant companies came to dominate the market. Then borrowed money and leveraged funds made every movement more extreme. This was not a completely fake boom. The companies at its center were earning real money, lots of it. But the market was like a powerful engine attached to an unstable frame. Once it started shaking, the engine could not keep everything under control. The story begins with AI memory. AI processors can perform enormous calculations, but they need a constant supply of data. Imagine the world's fastest chef. The chef can prepare hundreds of meals at once, but only if the ingredients are nearby. If the chef must run downstairs for every tomato, all that speed becomes useless. High bandwidth memory solves that problem. It keeps huge amounts of data close to the AI processor. It can also move that data extremely quickly. South Korea is home to two of the world's most important memory manufacturers, SK Hynix and Samsung Electronics. In the first quarter of 2026, SK Hynix reported 52.6 trillion won in revenue. Its operating profit reached 37.6 trillion won. That produced an operating margin of 72%. In simple terms, the company kept about 72 won in operating profit from every 100 won in sales. Samsung also reported record results. Its quarterly revenue reached approximately 133.9 trillion won. Its operating profit reached 57.2 trillion won. These were not hopeful predictions about the future. They were reported business results. South Korea's exports confirmed the same trend. Exports rose 53.2% from a year earlier in May. That was the fastest annual increase in more than 4 decades. Semiconductor shipments also reached a record. Here's the surprising part. Samsung and SK Hynix shares more than doubled, yet their expected profits rose even faster. As a result, the shares became cheaper relative to their forecast earnings. That is unusual during such a powerful rally. So, describing the entire boom as meaningless speculation would be wrong. The AI memory business was genuinely producing extraordinary profits. But chips were only the first part of the story. The second part involves South Korea's corporate governance reforms. Korean companies have often traded at lower valuations than similar companies elsewhere. Investors call this the Korea discount. Part of that discount came from concerns about controlling shareholders. Investors also worried about complicated conglomerates and weak protection for smaller shareholders. New reforms were designed to address those problems. Companies generally must now cancel newly purchased treasury shares within 1 year. Regulators also introduced stronger disclosure and shareholder protection requirements. These reforms encouraged investors to reconsider Korean stocks. They helped support the rally, but they did not cause the market's violent daily movements. For that, we need to look at the KOSPI itself. The KOSPI is South Korea's main stock index. It contains hundreds of companies. However, larger companies have more influence over the index. As Samsung and SK Hynix soared, they grew to represent just over half of the entire KOSPI. Imagine a report card with 10 assignments. Now imagine that 2 assignments count for more than the other 8 combined. You could improve everywhere else, but if those 2 giant assignments fall, your entire grade still collapses. That was the KOSPI's problem. Samsung and SK Hynix were not only enormous, they were also connected to the same AI memory story. If investors became nervous about AI spending, both companies could fall together. Since they controlled more than half the index, the entire Korean market would fall with them. For comparison, even Nvidia represented only about 7% of the S&P 500. Samsung and SK Hynix had far more influence over Korea's index. The KOSPI was beginning to act less like a national stock index. It was acting more like one enormous bet on AI memory. Then, investors added leverage. A leveraged exchange-traded fund is designed to multiply the daily movement of a stock or index. A 2 times fund aims to rise about 2% when its target rises 1% that day. It also aims to fall about 2% when the target falls 1%. The word daily is important. These funds repeatedly adjust their investments. After prices rise, they may need to buy more. After prices fall, they may need to sell.
That can make the original movement even stronger. Think about placing a microphone too close to a speaker. The microphone picks up a small sound. It sends that sound back through the speaker. The sound becomes louder each time it travels through the system. Soon, one small noise has become a painful squeal. Leveraged funds can create a similar feedback loop. They can amplify both rallies and sell-offs. A twice-leveraged fund tracking SK Hynix became the world's largest fund of its kind. Some leveraged products were trading more actively than the shares they were supposed to track. The amplifier was becoming almost as important as the original sound. Borrowing by individual investors added even more pressure. By mid-July, borrowed investment in KOSPI shares had reached approximately 28 trillion won. That was close to its record level. When borrowed shares fall too far, the investor may receive a margin call. The investor must provide more cash, otherwise the broker may sell the shares. Those forced sales push prices lower. That can trigger more margin calls. Then more shares are sold. One falling domino knocks over the next one. So, what started the correction? There was no single event. Investors began questioning whether American technology companies could keep increasing AI spending. They also wondered whether memory chip prices could remain so high. Global semiconductor stocks started falling. Foreign investors reduced their Korean holdings. Other investors simply took profits after the enormous rally. In a normal market, this might have caused an uncomfortable correction. In South Korea, those concerns hit the two companies controlling more than half the index. Leveraged funds and borrowed money then magnified the decline. The Bank of Korea also raised interest rates from 2.5 to 2.75%. It cited strong growth, inflation, and financial stability concerns. Higher rates were not the main cause of the correction, but they added pressure while the market was already unstable. Regulators eventually stepped in. They temporarily stopped approving new single-stock leveraged funds. They also tripled the minimum cash requirement for trading these products. Those changes may reduce future risk, but they did not remove the leveraged positions that already existed. This also explains why the market can suddenly rebound. When investors receive good news about chip demand, Samsung and SK Hynix can rise together. Their enormous index weights lift the KOSPI. Leveraged funds can then amplify the movement upward. The same machine works in both directions. A powerful rebound does not prove that every risk has disappeared. A powerful decline does not mean the chip companies suddenly stopped making money. There is also an important difference between the KOSPI and South Korea's wider economy. Semiconductor exports are booming, but domestic spending has remained much weaker. Many households and smaller businesses may not feel anything resembling an AI boom. A national stock index can soar without the entire country sharing equally in that success. Does South Korea's experience prove that the American market will crash next? We will see. The United States also has growing AI concentration and leveraged products. But the S&P 500 remains more diversified than the KOSPI. South Korea demonstrates what can happen when real earnings, extreme concentration, and leverage become connected to the same popular idea. Is it providing a countdown to another market crash? The choice between bubble and fundamentals is therefore too simple. The chip profits were real. The export growth was real. The governance reforms were real. But the market surrounding those developments became fragile. Strong companies can still have unstable share prices. A profitable industry can still attract too much leverage. And an index containing hundreds of companies can still depend mostly on two names. Now you know why South Korea's stock market boom was neither completely fake nor completely safe. AI memory profits powered the rally. while concentration and leverage made every movement more extreme. The next time you type a question into an artificial intelligence chatbot, remember that the lightning-fast memory chips answering your prompt aren't just powering the future of technology. They can also quietly move the financial fate of millions of people halfway around the world.